All right, you finally decided. You're about to get involved in real estate and start your journey toward being a professional housing provider. It's an exciting time, but there's a lot to learn. It can be overwhelming when you're just surfing on Zillow or driving around town trying to figure out what's the first property you're going to buy. Hello, hello, hello. I'm Andrew and welcome to the Dad Manual. And this is my attempt as a dad, and only a dad, to talk about how I evaluate properties as a professional housing provider and a couple of tips that you can use if you're going to get started into real estate. So personally, I like to invest in single-family housing. This is because there are over 45 million Americans who right now just rent homes, meaning there's plenty of demand. In addition to that, I live in Northwest Ohio, so right now, real estate is very affordable where I'm at. And also, because we're in the Midwest, you've probably heard these stories about having good cash flow. I tend to find good cash flow in the properties that I rent, and let's be real. You can take an appraisal and try to go ahead and wave it around as if you have higher net worth. However, you can't buy groceries with an appraisal. You either have to refinance a loan or you have to sell a property in order to collect cash flow just because market values go up. If you have decent cash flow coming from your rents every single month, well, you can use that to pay the bills. You can use that as extra money to invest. I tend to like to have cash flows between 7 and 12% depending on the area I'm investing in, and this is going to show you exactly how I break those numbers down. So there are many people who don't like to use Zillow or the multiple listing service, the MLS, in order to search out their properties. Now, while I do recommend getting involved in a neighborhood and finding a good deal just by taking a drive around and seeing what you can find for sale by owner or even talking to other investors, I will say I typically start by looking at Zillow mainly because it gives you a good shot of everything that's on the MLS and you kind of get a good idea of what's actually happening in the neighborhood and what the asking prices are at that point in time. So in this example, we're going to be taking a look at a property in 43613 that I took a look at today, and this is not necessarily a property that I would purchase. However, I'm going to break down the numbers as to how I see this property and exactly whether or not it would make sense. And this is a formula that I use that I kind of robbed off of Bigger Pockets. It's a variation of their Foursquare, although I do it a little bit differently. So we can see this property here is located on 1539 Barrows Street in Toledo, Ohio, 43613. Now this property says it's selling for $65,000. It's a 3-bedroom, 1-bath, just over 1,000 square feet. And this is actually pretty typical of the neighborhood here, right? This is what I would call a B-class neighborhood, which means that I'm probably going to get 1.5% of my value of the house actually in rent. Now, when you're talking about different types of houses, I tend to break them down into A, B, C, and D neighborhoods. And I tend to find that if you're in a C or D neighborhood, chances are you're getting 2% of your value of your house in monthly rent to 3% or even higher. If you're in a B-class neighborhood, which is not necessarily a bad neighborhood, but it's also not the rich kid neighborhood, you're probably going to get 1.5, right? Most of America lives in a B-class neighborhood. When you're looking at an A-class neighborhood, right, now you're starting to talk about the doctors. You're talking about $400,000, $500,000, $600,000 houses where I'm at. And then when you're getting to the really A-plus neighborhoods, this is where the muckety-mucks live, as I like to call them, the hobnobbers. And they've got gated communities everywhere, and nobody likes to even, talk to their neighbors anymore. I tend to invest more in the B to C neighborhoods is typically where I go because Toledo's not a bad city. There are people who will tell you that we have extremely high crime, but if you look at overall trends since the 1980s, we're actually lower than we were then. And I grew up around the area, so I'm very comfortable about it. And since I grew up and I'm comfortable here, I'd like to go ahead and help be part of the repair process for the entire city. And the way I look at housing as a whole is there's a few different things that you can touch somebody with. You can go ahead and get food, you can get water, you can get housing, you can get education, and you can get treating them with respect. If we're looking at those items and I take care of somebody's housing, well, that's a big freaking deal. And there's a lot of places here that let's just say they need to be fixed up properly and taken care of so that way we can provide real affordable housing, not these San Francisco or New York prices you always hear people talk about. So coming back over here to this property, right? You can see that this property is in pretty decent shape. I'm not really a fan of the overall color scheme of the kitchen, but you know what? It'll do, right? There's not a whole lot of repairs here, and it looks like pretty decent before I'd ever step in the house. It looks like, you know, I've probably got a pretty decent water heater and a pretty decent furnace. Now, if I'm actually going to go through in the AC unit, if I'm actually going to go through, there's ways that you can tell how old these are by taking a look at the numbers on the side. But since I can't zoom up this picture at a high enough definition to know, we're just going to assume that there's not that much that needs to happen in this neighborhood. Now, if we're going to go ahead and talk about what else that I can figure out for this property, right? If I was to go ahead and take a look at the evaluation sheet that I created, and I use a variation of, oops, I made that too small. I use a variation of a Foursquare, which is something that Bigger Pockets came out with, right? The idea is basically you take your income, you minus your planned expenses, you come up with what your cash flow, and then you develop your rate of return, your ROI, return on investment. I actually have my own sheet that I use with this. And you can see I already pre-filled it out where I have 1959 Barrows, Toledo, Ohio, and this would actually be 436113, not 013. All right. But since the house is listed at $65,000, checking over with comps in the neighborhood, I can tell you that this house is primarily a 1.5 neighborhood, right? Which means that being a B-class neighborhood, I should be able to expect 1.5% of the house's value as far as what the monthly rent roll would be. Now, I did tend to look at the actual taxes, and this house only has $64 a month in taxes. It comes out to $771 or $772 for the entire 6 months. Insurance, this is how much I pay for an insurance on this type of property. If I was to go across all my properties, that's the going rate that I pay, basically $45 for a single family house with 3-bedroom. One thing that people don't tend to look at, though, is Capex and repairs. Now, I'm really big on setting money aside for both of these. You'll see that I have Vacancy up here, but we'll talk more on that later. I'm a big believer that you need to set aside at least 10% of every dollar that comes in rent. It needs to go in a side account where you're not going to spend it, you're not going to claim it. You can maybe invest it so that way you can pull it out from a liquid investment later on. However, it's got to be readily available. Because when a roof goes, right? Like, that's just the way it is. It's got to be taken care of. And if you're not putting 10% in the house for repairs, and you're not putting 10% in the house for CapEx, which is things like a new furnace, a roof, or new siding or whatever, then you're going to be surprised in the end. Now, in a situation like this, with a house that's probably going to rent for around $975, you'll notice I'm only putting in $98 a month, right? Well, over 20 years, just to give you an idea of how much money that is, over 20 years, that's like putting $23,000 on the side for repairs and $23,000 on the side for CapEx. So I'd be putting basically $46,000 to repair this home over 20 years by putting that amount in. Now, being that I deal with housing all the time, I have resources that I can go ahead and be my own general contractor. I can go ahead and I can use my property management services to cut down on some of the costs. There's lots of things that you can do to keep costs down. And one thing you have to be ready for when you're actually, buying a home and you're going to put it on the market is you have to be ready for the idea that this home, if you're going to buy it and rent it out, this home, you're not living there, right? So do not put on a B-class neighborhood, do not give them granite countertops. Why? Because A, if the countertops aren't damaged to begin with, laminate works just as fine, and you're talking a couple $100 compared to a couple $1,000. And B, I wouldn't I don't have granite countertops in my own house, so why in the blazes am I going to put them in a rental? Now, if you're going to go in one of those A-plus neighborhoods, right, that's over on the coast and in the gated community, well, then that makes sense, right? But, when I'm looking at a $65,000 house, I can't be putting aside, more than $100. I would come up with no cash flow if I did different. So in my area, property management, if you're going to use a property management service, costs roughly 10%. One thing they don't tell you about property management when you're starting to look at all these different investor portfolios is people will talk about, oh, I only pay 5% or I manage them myself, right? My favorite is that I manage them myself and they own like 4 houses. Because they manage them themselves. They get 4 houses. They have a second phone, and they're stuck fixing toilets, and they're stuck dealing with everything themselves, from like bed bugs to, to replacing doors or furnaces breaking or something, right? And it can be get a sewer. I tell you what, get a sewer line back up at 2 a.m. on a Saturday, and you'll be glad you have a property management service. I'll tell you that right now. It doesn't mean that you shouldn't manage them yourself. I want to be clear. In fact, I started managing myself, and not all of mine are actually under a property management service now because I'm not big enough yet. So there's a point in time where you probably start managing on your own to save a little bit of cash flow, and then you get so big that it becomes harder and harder to go ahead and treat it as if you're doing it yourself, doing all your own inspections, that you need to treat it as a business. Regardless, 10% is typically what you start out with if you're going to have a property manager. And the more properties that you have, the cheaper that rate gets. I do know of people who can get all the way down to like 6% because, they're bringing 40, 50, 60 houses to the table. So I also always include a bit of advertising and accounting expense. And this is because accounting as a whole isn't free. And this is a business, which means I need to pay an accountant at the end of the year. And if I'm not going to put aside any money for that across all the properties, well then, nobody's going to be able to take care of it. Now, you'll see I only put in 1%. So at the end of the day, on this property, I'm only going to go ahead and do $10, right, a month, which is only $120 a year that I'm setting aside. However, right, that $10, when you have 5, 6, 7 properties, pretty soon it pays for the entire accountant, and it could pay for a leasing fee, right, for a real estate agent as you have more and more properties. One thing to always keep in mind as well is that even though people are, they try to roll everything up into the cash or into the actual loan, closing costs are not always static, right? Like sometimes you can be paying closing costs up front and you have a rehab budget. No matter what the property is, I don't care how good it looks, I always set aside $3,000. And the reason is, it never fails. If you don't have it, you'll need it. It's kind of like Murphy's Law. And if you're going to onboard a house into, say, a property manager, you're going to need down payments anyway. And somebody's going to have something that you need in that fund to begin with when you start. So I talked about having a repairs fund and a Capex fund. It's great that first month of rent that I'm going to go ahead and collect $98. But if I start that account with $0, right, then I only have $98 to replace the fridge if it breaks in the first month. So I put $3,000 to start that account always. Now in my area, cash down payments are basically 20%. I know you're going to hear a lot of people talking about house hacking, and that's great, right? And you can do that. You can get all the way down to 3 and 5%. However, when I talk to bankers around the area, in almost every single case, you can only do that for the first 10 houses. They only like to do it for the first 5, but they'll only let you do it for the first 10. I did find one place that does do 20, but I haven't used them personally. So I tend to deal in something called a portfolio loan, which means I will go ahead and have 3, 4, 5 houses together in one loan. And those houses are tied together, and by giving it by having its own portfolio, they will issue a line of credit on that. Part of that reason is bankers don't like to issue loans that are less than $50,000 as a whole. And you'll notice that if I'm putting 20% down here, well, this whole loan spread as a whole is only $52,000. They don't like to do less than that, okay? So you'll notice since I put in this number, everything comes on over here to the side. My total monthly rent roll comes on in. I've got listed up here to begin with. You'll notice a 15-year, 4.5% loan. I'll be honest with you guys. I know Rich Dad, Poor Dad likes to pitch that you can get every house in America at a 30-year loan. A lot of banks don't like to deal with 30-year loans unless you're going to have higher interest rates. And when you're going to go portfolio loans as a business, they like to do something called 5-to-1s, which means that you're setting up for a 5-year locked, and then they can come back to you after 5 years and renegotiate with you. So I like to get mine at 15 years. Right now the going rate's about 4.5%. And then if I can get a better percentage rate later on, or if I can find a place to go ahead and make it for a 30, then at the end all it's going to do is it's going to take my cash flow and it's going to increase it. You'll notice here that on my personal sheet here, that I can break down the whole thing, and I can change it from 15 to 30 and it automatically calculates. So even though I'm going to shoot for finding a bank that's going to be a 30-year loan, I'm going to plan on a 15. And one of the big reasons I'd say to plan on doing it for a 15 is no matter what happens when you first start out with a property, almost always you're going to get surprised by something in the beginning. And the last thing you want is to not be able to afford the bills. So if you plan conservatively up front, then you're more likely to be able to succeed. So in this case, you'll notice that it says that if I can, plan on paying a $400 mortgage, then yeah, I may only have a $264 mortgage because maybe I got a 30-year 4.5% loan. But the reality is I'm able to positively pay a $400 mortgage, which means that if something comes up that I need to pull another $130 to help out my repairs, it's not killing me, right? Because this is only a planning tool. At the end, you're going to try to do everything you can to go ahead and squeeze another dime out and not spend $1 if you can, right? That's just the way it is. So you can see we start up here with, $975, which is the amount of rent that we are assuming we're going to get, right? We start over here with unexpected taxes, which we already put in over here on the side, taxable income, minus insurance, minus the mortgage. Some places you are forced to pay the water yourself as a landlord as opposed to the tenant. That's actually the way it is in Toledo, Ohio, which is extremely silly in my mind. However, it's written into all my contracts that the tenant pays the water, and the first money that they pay actually goes toward the fees of the water before it comes in as rent. So that's a quick, easy tip to get around it for you. But you subtract your money for repairs, your Capex, your property management, your accounting, you come up with the total monthly expenses, and then you go ahead just income minus expenses, and your ROI on a property like this would be 11.4%, right? If we were to imagine that, say, this was a completely paid off property, I'd be looking at a cash-on-cash return of 9.73%, which would be pretty decent overall. And this property could cash flow you $564 after putting money on the side and properly repairing it. I find that to be pretty reasonable, and it's one of the reasons I like Northwest Ohio income properties, because not only do we have less crime than a lot of areas, in addition, they tend to cash flow fairly properly, and people are just not jerkbags, right? So one thing we haven't covered yet is vacancy. I personally like to go ahead and plan for being able to cover 20% vacancy. Now, it's impossible to have 20% vacancy on one house, and I get that, right? But imagine you had 10 houses. If you had 10 houses, it's not unreasonable to think that 2 of them could be vacant at any point in time. And as long as you know that during that process you're still going to positively cash flow, then I think you should be pretty safe overall with your assessment. If I come by here and I just put this back to 1, you'll notice that I am a little bit negative since I've only got 1 property in this equation. However, keep in mind that if it's vacant, I don't necessarily have to, I could not be paying property management expense, and I could manage it myself during this turnover, right? So the idea being that in that case, I'm actually back up here. I'm in turnover mode anyway. It doesn't really matter. So now that you've seen how I calculate a property, there is one thing I should specify about this property, and that is probably the fact that on its own, by itself at 20% down, I would probably not bid or purchase this property. And that's because the cash flow is only ranging about $160 some per month on that property. And I personally have a rule, I like to be above $300. To do that, I would have to give a 50% down payment down, pay $32,000 down. And while I'm not against doing that, most traditional banks don't like to issue home loans for $32,000. This would mean if I was going to actually be serious about purchasing this property, and I think that it is not necessarily a bad property to purchase as part of a portfolio, I would have to buy it within a portfolio in order to make it worth my while. This would mean that I would need to go ahead and grab more money together, bring a portfolio of say 4 or 5 houses, take it to the bank, bring my down payment then, and say, hey, now with this portfolio, I'm willing to go ahead and deal at 15 years or even try to push for 30 years. Lastly, When you're looking to buy properties, I recommend you seek out your local investor network. Here in Northwest Ohio, we have Toledo REIA and we have Toledo PIN. Personally, I'm a member of both, and I find they're great resources for not only networking, contractors, but also real estate agents who are investor friendly. You can learn a lot by going and networking with other investors and learn about tasks that you never thought people actually deal with. And it's better to have an idea of how you're going to set up a plan than to get broadsided and blindsided out of nowhere. Well, that about wraps up today's episode. What I want to know, though, is how you calculate rental property numbers. Tell me about it down in the comments below. And thanks for joining me today. If you haven't done so already, please consider getting that thumbs up, hitting that subscribe button, and consider sharing this with one of your friends. It really does help out the YouTube channel. Here we produce videos every Tuesday and Friday. And until next time, I'm Andrew Sherman. This is the Dad Manual. And always remember, failure isn't bad. Failure to try and learn is. Have a good one.